Imagine you're sitting on $147 billion in cash.
Right. Just a completely unfathomable amount of money.
Yeah, exactly. And you're shattering sales records all across the globe. You're reaching this all-time high with over, 2.5 billion active devices in people's pockets, on their wrists, on their desks.
Everywhere, basically.
Everywhere. But behind closed doors, in those executive boardrooms, you are quietly sweating over the rising price of memory chips.
It's the ultimate paradox of mega cap tech right now. I mean, on one side of the ledger, you have this unparalleled financial dominance, right?
Right.
A war chest that literally rivals the GDP of small nations. But then on the operational side, you have these very real, almost existential vulnerabilities tied up in the global supply chain.
So welcome to this deep dive into Apple's Q2 2026 financial results. Our mission today is to really unpack a completely historic $111.2 billion quarter.
A massive quarter.
It really is. And we're going to examine a huge changing of the guard in leadership, too. But fundamentally, we are going to explore how this company is aggressively rewriting its playbook, for managing this colossal mountain of cash right in the middle of looming supply chain threats.
Yeah, and we are going to connect those macro financial strategies. So the share buybacks, the debt restructuring, these multi-billion-dollar manufacturing shifts directly to the features, the availability, and frankly, the price of the gadgets you rely on every single day.
Let's just start right at the top because we have to address the headline that kind of changes the entire gravity of this earnings report. Tim Cook is stepping down.
Yeah, the end of an era.
Truly.
Yeah.
After this legendary 15-year run as CEO, he's moving to executive chairman this September, passing the baton to John Ternus, the current senior vice president of hardware engineering.
Which is a huge transition.
It is, and I want to push on this for a second, because moving from Tim Cook, who is, let's face it, fundamentally a supply chain and operations savant.
Oh, absolutely.
Moving from him to a pure hardware engineer feels like a massive shift in their corporate DNA. I mean, are we looking at a radically different Apple here?
Well, that is the multi-billion-dollar question the market is asking right now. And you can actually see that anxiety addressed in Ternus's immediate public statements.
Oh, really? How so?
So he didn't come out talking about, revolutionary new form factors or changing the design language. He immediately emphasized strategic continuity.
Interesting. Calming the waters.
Exactly. He pledged to maintain the strict, quote, financial discipline that really defined the Cook era. He essentially wanted to signal to Wall Street that, yes, an engineer's taking the wheel, but the operational rigor, the margins, the supply chain mastery, none of that is going to slip.
Which is good because he is inheriting an absolute fortress, by the way. I mean, just look at the top line for Q2.
The numbers are staggering.
They are. Revenue hit $111.2 billion. That is up 17% year over year. Net income sits at $29.6 billion. And the iPhone, which, people keep predicting will eventually plateau.
They've been predicting that for a decade.
Right. But it surged 22% to $57 billion, driven almost entirely by the new iPhone 17 family.
But, the real story there isn't just the sheer volume of iPhones sold. It's actually where they are selling.
Okay, break that down.
Well, we are seeing just explosive growth in emerging markets. So Greater China was up 28%.
Wow.
Yeah, but the stat that really stops you in your tracks comes from India. Over half of the buyers across Apple's major product categories in India are entirely new to the ecosystem.
Wait, over half?
Over 50%, yes.
That fundamentally changes the narrative, I think, because we're so used to thinking of Apple's growth in the US or Europe as this upgrade cycle, right? Like convincing someone to trade in their old iPhone 13 for a 17.
Exactly, replacing existing devices.
Right. But in these emerging markets, they're essentially colonizing an entirely new digital middle class.
And capturing a new user is the absolute holy grail for their business model. Because once a consumer enters that ecosystem, whether it's through, an entry-level iPhone or an iPad, the switching costs become incredibly high.
Because they get locked into the software and the services.
Exactly. So Apple is leveraging this hyper-localized marketing, massive expansions of their physical retail footprint, and these really strategic financing options to capture that rising middle class. They aren't just selling a device today, they're securing a decade of recurring revenue from a brand new demographic.
Which perfectly brings us to the gateway drug for a lot of these new users and the specific hardware that's driving this massive surge. Mac revenue grew 6% to $8.4 billion.
Yeah, a really solid jump for Mac.
And the sources point directly to the incredible reception of the new MacBook Neo.
Well, the MacBook Neo is just a masterclass in market expansion. It's a more budget-friendly laptop, but it has driven significant market share growth and brought in just record numbers of new Mac customers globally.
But it's not just the price, is it?
No, not at all. The real engine of demand for the Neo and really the broader Mac lineup right now isn't just that aggressive price point. It is the integration of agentic AI running locally on Apple's new A19 and M5 silicon.
Okay, I want to pause right there on agentic AI because that term is getting thrown around a lot lately.
It is the buzzword of the year.
Right. And when I think of AI on a laptop, my mind immediately goes to like a chatbot that writes my emails or summarizes a PDF for me. Why is agentic AI fundamentally different, and why is it causing people to literally clear out inventory?
So a chatbot is reactive. You ask it a question, it gives you an answer. Agentic AI is autonomous and goal-oriented. It can actually plan and execute multi-step workflows.
Okay, give me an example. What does that look like in practice?
Imagine telling your laptop, audit these 3 spreadsheets, compare the Q1 discrepancies against our historical averages, draft a summary email to the finance team, and then schedule a meeting for Tuesday when everyone's calendar is open.
That's a lot of steps.
Right, and agentic AI breaks that complex request down into individual steps, opens the necessary applications on its own, and actually does the work.
And the critical differentiator here, from what I understand, is that Apple is doing all of this locally.
Yes, exactly.
Like it's happening right on the M5 chip sitting on your desk, rather than firing all that sensitive, financial data up to some cloud server.
Exactly. It is a massive leap forward in both speed and, crucially, privacy. But ironically, this massive leap in capability is creating a severe operational headache for them.
The supply issues.
Right. The demand for these AI-capable Macs has led to just brutal supply constraints.
No, I have to play devil's advocate here for a second. I hear analysts panic about quote-unquote supply constraints all the time, but isn't selling out of your newest product a luxurious problem to have?
You'd think so.
Like, if I'm an investor, I want to see sold-out signs, right? Doesn't a 3-month wait list for a MacBook Neo just turn it into the tech equivalent of a Birkin bag? It drives exclusivity, it builds hype, and it proves the demand is rabid.
Well, in the world of high fashion, sure, artificial scarcity builds brand equity. But in the tech industry, scarcity is a massive liability.
Really?
Yeah, because a bottleneck right now isn't some marketing gimmick. It's a hard limit on advanced node SOX system on chips.
The processors.
Right, these incredibly complex, densely packed silicon brains of the devices. Products like the Mac Mini, the Mac Studio, and this new MacBook Neo are facing supply-demand imbalances that Apple openly admits may take months to resolve.
So you are saying the hype doesn't outweigh the lost sale?
Think about the actual consumer. If a college student needs a laptop for the fall semester, or, a small business needs to outfit 3 new hires today.
They can't wait until November.
Exactly. If Apple tells them it's a 12-week wait, they don't wait. They walk across the street and they buy a high-end Windows machine.
Ouch.
Right, and that isn't just a deferred sale. It is permanently lost revenue, a lost user for your high-margin services ecosystem, and market share that is handed directly to your competitors. You simply cannot monetize an empty shelf.
That is a really harsh reality. So if physical hardware is currently hitting the silicon bottleneck, Apple has to, I guess, squeeze more juice out of the lemons they have already sold.
That's the strategy.
They have to heavily monetize the 2.5 billion active devices that are currently sitting in people's hands.
And that pivot leads us straight into the absolute juggernaut of their earnings report, the services division.
The numbers here are almost difficult to comprehend. I mean, services hit an all-time revenue record of $31 billion, up 16%.
Incredible growth.
But the revenue isn't even the most shocking part to me. It's the gross margin. The services division is running at a 76.7% gross margin.
Which is almost unheard of at that scale.
Yeah.
That margin is what transforms Apple from just a hardware manufacturer into this unparalleled cash-generating machine.
Right.
Just to put that in perspective for you, their hardware products have a gross margin of around 38.7%, which, by the way, is already industry-leading for hardware. But every dollar earned in services, whether it's iCloud storage, the App Store cuts, or Apple Music, is vastly more profitable than selling a physical block of aluminum and glass.
But looking at the sources, a massive driver of the services growth is their rapidly expanding advertising strategy.
Yes, advertising is becoming huge for them.
They are expanding App Store ads, and this summer, they are integrating ads directly into Apple Maps in the US and Canada. And I have a major problem with this, and I really want to hear your take.
Okay, let's hear it.
Apple's entire brand identity, like the reason people gladly pay a massive premium for their hardware, is built on this pristine, privacy-first, user-centric experience.
Right, it's a clean ecosystem.
Exactly. So if you turn services into a billboard, literally dropping sponsored pins into my navigation app, don't you risk eroding the exact brand trust that justifies your high hardware prices in the first place?
You're highlighting the ultimate tightrope that John Ternus and the executive team have to walk right now. I mean, management's official stance is that they can deliver highly relevant advertising that helps businesses grow without compromising fundamental privacy rights.
But how do they do that without tracking everything I do?
Well, they are adamant that their ad network relies on broad contextual signals, not the granular cross-site tracking that defines other ad platforms.
But an ad is an ad. I mean, if my screen feels cluttered, I'm going to notice, regardless of how they targeted it.
And that is the risk, definitely. It's a slow burn. If the user experience begins to feel overly monetized at every single touch point, that premium sheen undeniably wears off.
Yeah.
They're basically betting that their users are locked in enough and the ecosystem is seamless enough that consumers will tolerate a creeping ad presence in exchange for the overall utility.
It just feels like a dangerous game of chicken with user loyalty. But let's look at the other pillar of the services and software ecosystem, which feels much more secure, honestly, and that's enterprise AI.
Oh, this is a fascinating area.
We talked about on-device Apple Intelligence earlier, and the sources show it is creating massive corporate value right now.
Huge value.
Marsh, the global professional services firm, is forcing an upgrade to the iPhone 17 specifically for secure AI development. Freshworks just deployed 5,000 Macs for their AI developers, and Kansas City Public Schools completely ripped out their Windows and Chromebook infrastructure to switch to the MacBook Neo.
Those enterprise and education wins are strategic gold mines for Apple.
Why is that?
Because when a massive corporation or an entire school district adopts your hardware, they aren't just buying a badge of laptops. They are deeply integrating your operating system into their daily workflows.
Right.
It creates incredibly sticky, recurring revenue that is very, very hard for competitors to dislodge later.
But why the sudden shift in education? Because Chromebooks have dominated schools for decades simply because they're cheap. Why is a public school system suddenly dropping money on MacBook Neos?
It comes right back to the architecture of that M5 chip and the local agentic AI we were talking about.
Oh, the privacy aspect.
Exactly. Think about a hospital system, a financial firm, or a school district handling student data. If you are using a cloud-based AI, every time you ask it to analyze a patient record, a proprietary algorithm, or a student's grades,
You're sending it out.
yes, you are transmitting that sensitive data out of your secure network and into a third-party server farm.
Which is a massive security vulnerability.
Precisely. So running complex AI models entirely on device gives these institutions the immense productivity benefits of artificial intelligence, but with the security of an ironclad, closed system. Apple isn't just selling them a faster laptop, they're selling them data sovereignty.
Data sovereignty, that makes total sense.
It's a huge selling point.
But we need to pivot because there is this dark cloud hovering over all of this incredible profitability. We talked about their overall gross margin sitting at an astonishing 49.3%.
Yes, a beautiful number for investors.
But the sources outline a primary, unavoidable threat that could seriously compress those margins in the coming quarters.
Yeah, the global supply chain is rearing its head again. We have to look at the soaring cost of memory, specifically DRAM and NAND chips.
Right. And to really understand why memory is getting so expensive, we actually have to look outside of Apple, don't we?
We do.
Because it isn't a smartphone problem, it's an AI problem.
It is entirely driven by the enterprise AI boom. Think of the global memory supply like a city's water reservoir.
Okay.
For years, consumer electronics, laptops, phones, tablets were the primary neighborhoods drawing from that reservoir. But recently, a massive, incredibly thirsty industrial plant moved in upstream. And those are the enterprise AI data centers.
Like the massive server farms training global large language models.
Exactly.
Yeah.
Training and running those colossal models requires astronomical amounts of high-performance, high-bandwidth memory.
So what are the manufacturers doing?
Well, the suppliers who actually manufacture these chips are actively diverting their production capacity away from consumer-grade memory and redirecting it to the highly lucrative data center market.
So the supply of memory available for, say, a MacBook or an iPhone is shrinking rapidly, which causes the price to skyrocket.
The basic supply and demand.
And the sources noted that Apple was somewhat protected in December and March because of their carry-in inventory. They essentially locked in lower prices months ago.
Yeah, they had a stockpile.
Right. But management issued a really stark warning on the earnings call. They stated plainly that memory costs will get significantly higher starting in June. The cheap inventory is gone.
It's over.
So bring this home for us. When memory costs double or triple for Apple, how does this actually impact the listener's wallet down the line?
Well, it forces Apple into a classic high-stakes strategic dilemma. When the underlying cost to build a phone or a laptop surges, a tech giant essentially has two levers they can pull.
Okay.
Option A, you raise the retail price. You charge $1,300 instead of $1,200, passing that inflated memory cost directly to the consumer.
Which protects that pristine 49% profit margin we talked about.
It protects the margin, yes, but it risks cooling off demand, especially in those price-sensitive emerging markets like India that we just highlighted as their big growth engine.
Right, you can't just hike prices indefinitely. So what is option B?
Option B is you need the cost. You keep the retail price steady, but you let your profit margin take the hit.
And that is where the attrition war begins, isn't it?
Oh, absolutely.
Because if Apple keeps prices steady, they basically weaponize their margins against smaller competitors. Like a smaller PC manufacturer operating on razor-thin margins simply cannot afford to absorb a massive spike in memory costs.
Oh, no, they'd go bankrupt.
Right. They have to raise the prices of their laptops just to break even. So if Apple holds the line on the MacBook Neo, they suddenly become the more attractive, aggressively priced option, allowing them to bleed their competitors out and steal massive market share.
It is a brutal, highly effective strategy if you have the balance sheet to survive it. But it's worth noting that management was very disciplined on the earnings call. When pressed by analysts about price hikes, they simply said they were evaluating a range of options.
Playing it close to the vest.
Exactly.
Yeah.
They are not tipping their hand to the competition just yet.
Which is smart. You never show your cards. But to play that game of margin attrition, to be able to absorb massive global supply shocks without blinking, you need an unparalleled financial foundation.
And they have it.
They do, and this is where the deep dive gets really fascinating to me because Apple is completely restructuring how it wields its cash reserves right now.
This is a huge shift in their corporate finance.
We mentioned earlier that they ended the quarter with $147 billion in cash and marketable securities, and that's balanced against $85 billion in debt.
Right.
But the massive policy shift highlighted in the sources is that Apple is officially abandoning its net cash neutral target. And this is a financial philosophy they have religiously adhered to since, 2018?
Yes, for years.
So break this down for us. What exactly is a net cash neutral target, and why did they even have it in the first place?
So net cash neutral was a heavily publicized financial goal where Apple basically aimed to reduce their massive cash pile until it exactly equaled their total outstanding debt.
So essentially aiming for a net balance of zero.
Exactly. And for years, they achieved this by aggressively buying back their own stock and paying out huge dividends, methodically draining the cash reserves down so it matched their debt load.
It sounds so counterintuitive. I mean, why would a company intentionally try to shrink its war chest?
Well, from a pure efficiency standpoint, Wall Street loved it. Cash sitting idly in a bank account loses value over time due to inflation.
Sure.
By returning that excess capital to shareholders, they were maximizing the efficiency of their balance sheet.
Okay, so if it was so efficient, why abandon it now? Why does dropping this safety net target actually give a tech giant more power in today's landscape?
Because the global landscape has fundamentally changed since 2018. We are no longer in an era of stable, predictable globalization. Supply chains are routinely weaponized. Geopolitical tensions are incredibly high.
Right, the world is messier now.
Much messier. By abandoning that strict neutral target, John Ternus and the CFO are giving themselves absolute operational freedom. They will now manage cash and debt completely independently based on what the market actually demands.
So they aren't forced to just spend money to hit some arbitrary zero balance at the end of the quarter.
Precisely. If interest rates are favorable, they can hold more cash. But more importantly, if they need to aggressively secure their supply chains against the exact kind of bottlenecks and memory spikes we just discussed, they now have the unrestricted flexibility to deploy massive, unprecedented amounts of capital without violating their own financial mandates.
And they are absolutely flexing that financial muscle right now because alongside this policy shift, they announced a historic $100 billion share buyback authorization, and they increased their dividend by 4%.
Yeah, the market reacted very strongly to that.
I mean, that isn't just routine corporate finance. That is a billboard to the market.
It is a massive display of confidence. A $100 billion buyback sends a crystal clear message to investors. Management believes their own stock is undervalued. And despite the looming threats of memory costs and SOC 2 constraints, they are generating so much recurring cash from the iPhone and services that they can comfortably hand $100 billion back to their owners.
It's wild.
It really reinforces long-term shareholder value in a way very, very few companies on Earth can match.
But the fascinating part to me is that they aren't just funneling all this unleashed capital to Wall Street. They are using this new financial flexibility to physically build a moat around their future.
A literal manufacturing moat.
Yes. The sources detail a staggering $600 billion commitment to U.S. manufacturing over the coming years. They are moving production of the Mac Mini to a brand new facility in Houston, Texas. And critically, they are purchasing over 100 million advanced chips directly from TSMC's new fabrication plant in Arizona.
This is where you see cash transformed into a geopolitical weapon.
Tell me more about that.
Sourcing advanced node chips from Arizona and assembling computers in Texas isn't some public relations campaign for them. It is a strategic layering of defenses.
How so?
First, it directly attacks the exact bottleneck that is choking Mac sales right now. If you have dedicated pre-purchase capacity from a fab in Arizona, you are not fighting in the open market for overseas allocation.
Right. You essentially own the water source before it hits the river.
Exact.
And the second defense.
Insulation from global trade shocks. The earnings call explicitly mentioned the ongoing impact of tariffs and trade disputes. By aggressively funding and utilizing an end-to-end silicon supply chain within the borders of the United States, Apple is effectively buying immunity from international trade volatility.
They are using their cash to build a domestic fortress.
A fortress they control entirely.
So let's take a step back and synthesize this entirely new landscape. We are looking at a company hitting jaw-dropping revenue records fueled by the enduring dominance of the iPhone 17 and that really aggressive expansion into emerging markets like India.
Right, finding massive new user bases.
And we are watching the dawn of the John Ternus era, where a hardware visionary has to prove he can maintain ruthless financial discipline.
And we are also seeing a profound pivot in their technology stack. The push into agentic AI isn't just a fun consumer feature. It is securing their grip on the enterprise market by offering unmatched on-device data sovereignty.
But the threats are incredibly real. The global AI boom is devouring memory supply, threatening to crush Apple's pristine profit margin.
Which is a huge risk.
And in response, they have taken the leash off their capital. They abandoned restrictive cash rules, authorized $100 billion in stock buybacks, and are pouring hundreds of billions into U.S. supply chains to secure their own silicon.
And this is exactly why you, the listener, need to pay attention to these macro moves. Apple's pricing decisions in the face of these memory costs will set the baseline for what you pay for electronics across the entire industry next year.
Yeah, whatever they do, everyone else follows.
Exactly. And their integration of agentic AI is going to fundamentally redefine your expectations for what a laptop should be able to do autonomously.
It's not just corporate finance, it's the architecture of the tools we use to live our lives. But before we wrap up this deep dive, I want to leave you with a final forward-looking question to mull over.
Okay, let's look at the pieces currently on the board. John Ternus is at the helm. There is an existential mandate to dominate the agentic AI ecosystem. And they have just formally abandoned the net cash neutral rule, unlocking unprecedented, unrestricted financial flexibility with $147 billion in liquid capital.
Right, which begs the question, is all of this supply chain fortification just the calm before the storm?
What do you mean?
Well, for years, Apple has generally avoided massive landscape-altering acquisitions, right?
True. They usually buy smaller bolt-on companies.
Exactly.
Right.
But with the cash leash finally taken off and the AI wars escalating by the day, are we about to see a much more aggressive acquisition-hungry Apple step into the M&A arena?
Oh, wow.
Like, are they stockpiling this capital to simply buy up the foundational AI models and robotics companies needed to absolutely dominate the next decade of tech.
It's a completely plausible scenario. They have always had the war chest. But now, for the first time in almost a decade, they actually have the stated strategic freedom to use it however they see fit.
It really makes you look at that opening image a little differently, doesn't it?
Yeah.
Sitting on $147 billion in cash isn't just about financial security anymore. It's about having the sheer ammunition to shape the future of global technology entirely on your own terms.